Vikas? Thank you, Father, for your lovely prayer and the introduction to set the ball rolling for today's topic. I hope the topic will benefit everyone and your introduction will set in motion the purpose of the meeting. May I ask now Mr. Mayank Khemka to take over?
Vikas Khosla, please unmute Vikas Khosla because I think Vikas is speaking.
Achha,
Yes.
I don't know. I thought he can unmute himself. I think you can all unmute yourself. Yeah.
Vikas, you are audible now.
Please.
Thank you, Reverend Father. I take this opportunity to introduce the two speakers.
We don't see you. Where are you?
It's
You are there.
First, Mr. Mayank Khemka, the Chief Investment Officer, India at Bombay for Deutsche Bank. He's from St. Xavier School and St. Xavier's College. And after his college, he went for his MBA at Notre Dame, USA. He has 25 years of experience in Indian capital markets, and he worked in various institutions like Credit Suisse, Ask Investment Managers, and SMIFS Group. We also have with us Mr. Naresh Pachisia, who is the founder and MD of SKP Securities, Limited, Eastern India's leading investment banker, award-winning private wealth advisor and brokerage. He's a commerce graduate also from St. Xavier's College, and he's had 38 years experience in financial markets, actively associated with CII, Family Business Network, International and Entrepreneurs Organization. I request Mr. Mayank Khemka to please start the session. Thank you.
Thank you, Vikas. Thanks, Father, for a lovely introduction and a summary of what's happened in the financial markets and the economy. Let me start off with maybe a summary of what we've gone through in the last 3 or 4 months, essentially on the economy side and a little bit on the market side. And I will probably try to correlate the two things so that it makes more sense for all the people who are participating today. Now, usually we've seen how recessions happen in economies, and there are leading signs to that. We see a lot of slowdown in economic activity. We see profits fall for companies, etc., etc. However, what happened in March was pretty much unprecedented. When you just come one fine day on a Sunday and say that, look, I am shutting down this entire country, and you shut down 1.3 billion people and their entire economic activity, there's obviously a huge shock to the economy. And that lockdown continued for 3 weeks, then for another 3 weeks, and then we started to open up slowly in May. But when you shut down such a huge machinery, it takes a long time before things can start again working properly. The wheels align themselves and everything gets properly oiled, and then they start to function as it used to normally. We are already 4 months in that period, and I don't think that we are still anywhere near close to normal or pre-COVID, so to say. Now, when you shut down an economy of such a size for such a long time, obviously there's going to be massive second rung effects on businesses, on jobs, on salaries, on a host of money related matters. And what predictions are there for the economy that we will probably see any sort of a reduction in GDP from -2 to -8%, depending on which institution is sort of predicting it. So it's pretty sure that the economy will contract in the current year. What also I can talk about is probably On the inflation side, we've seen inflation hasn't yet gone down. We are still seeing numbers of 6%, etc. And everybody is wondering, why is inflation still at such a high number? Now, when you shut down everything, there is obviously a full supply chain disruption. And when there is a supply chain disruption, it doesn't matter whether you were allowed to open your factory or your shop. But if your supplier did not supply to you because in his area there's a lockdown, if there are transportation bottlenecks, if there are logistic bottlenecks, how do you run your own business? So there is demand for, let's say, food products, but it's probably not been able to come to the shop that you buy from. Or as we all saw, probably we could not even order from Amazon in the month of April till a long time. So there have been supply chain disruptions, which probably are being sorted out now. And as we open up even further from next month, we will see that these supply chain disruptions disappear, and whatever that we want will come back. That will lead to inflation going down. What will happen in more medium term is there will be huge demand fall, because people have not been able to run their businesses, they're not being able to open the shops, nobody can go to those shops, nobody can go and buy stuff freely. There is obviously a lot of businesses which are shutting down in the smaller space. There are people who are losing their jobs, or even bigger companies have announced salary cuts. What this means is that the amount of income that you have for discretionary consumption will go down, or there will also be a big propensity to save. And therefore, people are not going to spend as much as we've seen before. And if that demand falls, you'll see also the economy sort of contracting even further. Remember, India is a very consumption-based economy, as opposed to China, which is more export-oriented, as opposed to many other countries which depend on external countries but not on their own. India depends mainly on our own consumption, which was already slowing down even before we went into COVID. But now you'll see a huge disruption over there. Now, what this means is probably by end of the year, inflation will fall to very low levels. Why am I saying all this? I'm just giving you a backdrop where I will try and correlate a lot of these questions, and you can see whether how that correlates into what the market behavior has been. Now, what really has been outstanding has been the Reserve Bank of India's actions to control this kind of a slowdown. They have reduced interest rates drastically. The repo rate now in India is 4%, which used to be about 6.5% only about a year ago. They have also reduced a lot of what they call the reverse repo rate, which is what the rate the banks get to park their excess liquidity with them. And they have done a huge number of qualitative measures. Now, I will not get into technical details like LTRO, TLTRO, etc., which is basically saying that they are providing liquidity to businesses, to banks, so that there is no let up in the credit. There is no let up as far as any business that needs money, or there is absolutely no defaults because liquidity is not available in the economy. Now, this is a playbook copied straight out of the Federal Reserve, what they've done in the US, and therefore India or other central banks in the world have done the same. The other bit is the fiscal stimulus that the government has done. Now, in India, we've still not seen that kind of a fiscal stimulus like the US has done, but there are opinions still scattered about that, whether what the US did was right or not, and whether India even has the wherewithal to actually give so much money in the bank to Indians because of our fiscal situation. But interest rates are now down. Our current account deficit is probably in surplus because we are importing less, we are consuming less, and also the oil price has fallen in the world. With this backdrop, I guess, and when I'm painting such a sort of recessionary picture or extremely gloomy picture for the economy, the question in everybody's lips is obviously, why is the markets going up in this kind of a scenario? Now, markets are extremely complex, let's say, beast. It depends on a number of variables at the same time. You probably cannot explain it on just one reason, that the economy is doing badly or we are in a lockdown, etc., etc. It depends on sentimental factors, it depends on behavioral factors, it depends on liquidity, it depends on a lot of other things. So what I'll try to do in this short period of time is probably give you or try to simplify why markets have gone up in very short. Now, in the long run, stock markets always will reflect what companies are doing. So if companies are showing good growth, good profits, good profitable growth, they are good managements, those companies continue to show very good performance. All else being equal, cut out all the noise, the stock market will reflect the price of that company as, you know, it is fundamentally sound. So that's in the very long run. And that's why you probably hear from most people say that, look, when you invest in equities, look at 3 years, look at 5 years, look at 7 years. Do not take a short-term view, because ultimately, you know, you cut out all of these short-term factors, what you will get in the market ultimately will be what the company has done. And therefore, companies which have performed will be rewarded with much higher prices. Companies which have fallen on the wayside will probably not even give you that price performance. But that's in the long run. And therefore, we are talking of a very short-term period of the current year. And in the medium run, I think the market gets very, very affected by a lot of macroeconomic variables. And which is why I gave you the backdrop, the macroeconomic variables, that the prime macroeconomic variable that matters to markets is interest rates. And therefore, as you know, interest rates have been cut not only by the RBI, but the banks have also cut interest rates, going down to the borrowers, you know, whether it's for home mortgages, whether it's for working capital loans, whether it's for personal loans. Rates are down by 2 to 3% from what they were, let's say, a year ago. Now, when interest rates go down, the equity markets have an inverse relationship. And therefore, markets will always look up when interest rates go down. Why? Because number one, the interest cost for companies usually go down because they're paying less interest, and therefore their profitability goes up. But more importantly than that, I would say that let's look at the most common way of measuring valuation in equity markets, which is the price earnings ratio. The price earnings ratio is essentially nothing but it tells you, let's say the price earnings ratio is 10, it tells you that in 10 years, the market cap of the company or the price that you're paying will be made up in profits by the company in 10 years time period. Or to give it even a more simplistic sort of a definition, that if you put money, let's say in a bank for 10%, you will probably, have a sort of a return for the next 10 years for 10%. And therefore, whether you invest in a company at a price earnings of 10, it should give you pretty much similar returns. But when the interest rate goes down to about 4 or 5, the price earnings multiple expands. Because as I said, it's an inverse relationship. Now, this is a little technical, but if the, let's say the interest rate is 5%, it becomes, the price earnings could expand to 20. On 10, it's, 10 times. On 5%, that becomes 20. And therefore, the price multiple earnings has expanded in the country, even though earnings are going down. And that is one way to look at the market in the medium term, that if interest rate remains low, the ask for the investor is obviously that the price earnings, has increased.